Hi, everybody, and welcome to myinvestmentclub.co.uk. I'm going to tell you about how we trade. My name is Jeff Fitzpatrick, and I support 7 clubs, and generally they're doing pretty well. So let's see how we do it. To get it in context, we're trading US stocks for very good reason. It is cheaper. There's more public information for research. There are actually a string of good reasons. And it is the Premier League of stocks. Any company around the world, doesn't matter if it's a British company, Japanese company, and so on, they will generally trade on US stock markets. So we trade short-term puts and calls, come to that, and we also buy and sell stocks. We're in search of 7% compound growth per month. The journey starts with our money. We all put in our investment and we end up with a pile of money, which, because there are more than one of us, it is actually much easier to trade with a figure that is significant. In terms of what we do, an account value needs to be at least $25,000 to be able to do it, to qualify to do it. So quite often, smaller players put their figures together to achieve that. And that works really well because it also shares any costs involved. Once we get going, so we put our money in, and because this is not a pension account, it's a straightforward trading account, the brokers match it. So they kindly provide us with a line of credit, and that doubles the buying power at our disposal. So that additional money is a loan. It's called margin, and they can demand repayment of it at any time. So we want to take advantage of the buying power that provides, but we don't want to actually use it. We will use the availability of the loan to back promises to buy shares that we don't end up buying. And we get paid a premium for making those promises, but we don't intend to keep all of them, even though we will keep the premiums that are paid to us for all of them. That's complicated, I know, but keep listening. It's a strange business. Think of us as selling insurance. Other traders are happy to pay premiums for the right to make us buy shares at pre-agreed prices on or before an agreed date. The traders have bought shares, and like a house, they're simply an asset. They fear that the value of that asset may drop drastically, and they want to buy the right to be able to sell the shares at a higher price if that happens. So we are the insurance sellers. And there's effectively an unlimited demand for the insurance that we sell. However, if called upon, we need to stump up the cash needed to buy those insured shares. And they won't be at prices that we like. That requires buying power, and our buying power is limited to the cash we invest, plus that which we can borrow. The insurance policies that I refer to are actually called puts because they give the buyer the right to put shares to us. The premiums we get are like a money machine. They add to our investment and the amount, therefore, that we can borrow to make more put sales. We end up with a large cash pile. Unfortunately, most of it, for most of the time, is tied up backing the promises we have made to buy shares if called upon to do so. So we can't just go and have a party with it. Fortunately, the collateral we back the put sales with can take the form of shares as well as the cash. Cash and shares are both assets, and we use the cash generated to buy shares. The strategy depends on us being able to identify top quality shares at low prices. We use a professional research company to identify the best quality shares available. The pool we select from has around 1,700 of the best shares in the world, out of the 30,000 or so available to trade. Our filters bring this down to around 10 or 15 high quality, great value stocks in well-managed companies for any given date. Then charts, you might know them as graphs, and indicators take over, and they point us towards entry and exit points. The trained club members that we have all have access to this research to benefit their own trading and to help them trade the club's accounts. Owning shares provides an additional money machine. We benefit from price appreciation, dividends, and the ability to generate more premiums by selling promises known as call options to sell our shares at pre-agreed prices on or before an agreed date if called upon to do so. And of course, we only promise to sell our shares at prices that are higher than we paid for them. Generating income from the asset of stocks is like owning a house that someone else picks up the bills for. If there's insurance to pay or maintenance costs, then we're not paying it. We'd be selling something that pays for it. So the services come free. We can even use some of the income to pay for insurance to give us the right to sell our shares at prices that are higher than we paid for them. We can become insurance buyers as well as sellers. But we'll be doing it with income that we generate. Some shares provide more buying power than cash does. Cash, we get $1 of extra buying power for each dollar that we put in, so $2 in total. Sometimes a very strong share will give more than that. It could be twice as much buying power as the $1 for $1. So we could own a share that had a value of, say, $10, and it could give us up to $40 of buying power. Hold on, this is all sounding a bit risky. What happens if we have to pay out on all of these policies? Well, we reduce the risk in several ways. First, making the promises we sell less likely to be required to be fulfilled by promising to buy at a lower price than the current price. Yes, you've heard me correctly. If we were looking at a $10 share, we can get paid for promising to buy it for $9 or $8. We regularly buy back those promises and then replace them with new ones that are set further in the future and sometimes involve a different share price. We might say, we don't like the $9 promise that we made. We'll buy it back. And then we'll sell a new one that says, well, okay, we're prepared to buy them for $8. Now, believe it or not, we will actually get a positive income stream from doing that. We also ensure that we only sell promises that use no more than 50% of the buying power available to us. That gives us a huge margin of risk cover and allows us to be able to cover the promises that we make. If needed, we can sell shares, sell some of the shares that we own, and use the resulting cash to pay for the shares that are put to us. An additional benefit of holding the shares is that we're building a large capital asset as well as producing an income. And when the time comes to cash it in, perhaps for retirement, happy days. This all sounds very complicated. It's not actually as complicated as it sounds. And there are two ways that you can sort out the complexities. Join one of our investment clubs. The members are learning together and are forming a very strong community. Typically, you might be amongst 50 or 60 people. Some of those are very, very passive. We don't actually ever hear from them. They don't come to meetings. They don't do anything. Others are very active, and some want to really learn to be able to do this for themselves. The other way of getting to grips with it is come along and join in one of our live training courses. You'll find details of these on the website. And here it is, myinvestmentclub.co.uk. So if you're interested in joining us, check out that website, call us, join a club WhatsApp group, talk directly to all or any of the hundreds of members, arrange a Zoom call to hear directly from us. You can find me on LinkedIn, and there's my email address, jeff@strivementoring.co.uk.